Most people will work their entire lives and never understand why they're exhausted but not wealthy. They'll grind 60-hour weeks, sacrifice weekends, neglect relationships, chase promotions, and still watch others accumulate in months what takes them decades. Here's the truth they're missing. The wealthiest people on earth don't work harder than you. They don't have more hours in their day. They aren't necessarily smarter or more talented. What they have is something invisible, something most people never learn to see, let alone use. They have leverage, and leverage is the single most important concept separating billionaires from everyone grinding in the middle class. Before we go further, let me be direct with you. This is a brand new channel, and I'm building something different here. Premium wealth insights that cut through the noise and get to the strategies that actually matter. I need your help to reach 100 subscribers. If what I'm about to share resonates with you, hit that subscribe button right now. And here's the challenge. I want to see if we can get 50 likes on this video. 50 people who understand that leverage changes everything. And drop a comment telling me where you're watching from. I want to know where in the world this message is reaching. These aren't just requests. If you're serious about understanding how wealth actually works, these actions are your first commitment. Now let's get into it. The fundamental equation most people operate under is fatally flawed. They believe wealth equals time multiplied by hourly rate. Work more hours, make more money. It's linear, it's predictable, and it's exactly why they'll never be rich. The wealthy operate under a completely different equation. Leverage multiplied by deployed resources equals exponential returns. 1 unit of effort doesn't produce 1 unit of result. It produces 10, 100, 1,000 units of result. That's leverage. And here's what nobody tells you. Leverage itself is invisible until it's embedded into systems. You can't see it, you can't touch it. But once you understand how to deploy it, everything changes. There are 4 primary levers the ultra-wealthy pull, and each one transforms input into multiplied output. Capital leverage, using other people's money. Code leverage, building solutions that serve millions from a single creation. People leverage, multiplying your capacity through strategic relationships and delegation. And media leverage, controlling narratives and attention at scale. These aren't abstract concepts. These are the exact mechanisms billionaires use every single day to compound wealth, while everyone else trades hours for dollars. Let me show you how this works in the real world, starting with a man who's been pulling the capital lever for over 6 decades. Warren Buffett is worth north of $100 billion. Most people think his wealth came from being brilliant at picking stocks. That's not wrong, but it's incomplete. Buffett's real genius wasn't stock picking. It was recognizing that the best returns come from investing other people's money, not your own. And he found a way to borrow that money at essentially zero cost. Here's how he did it. In the 1960s, Buffett began acquiring insurance companies through Berkshire Hathaway. Insurance companies have a unique characteristic called float. When you buy an insurance policy, you pay premiums up front. The insurance company collects that money today, but doesn't pay out claims until later, sometimes years later. That gap creates float. It's borrowed money with no interest, no repayment schedule, and no immediate obligations. As of 2024, Berkshire Hathaway controlled $171 billion in insurance float. Think about that number. $171 billion that Buffett could invest however he wanted, and it cost him almost nothing. Berkshire's cost of float averaged around 2.2% annually, more than 3 percentage points below what the government pays to borrow. So Buffett is borrowing cheaper than the United States Treasury. Then he deploys that capital into investments generating returns well above his borrowing costs. Buy stocks that appreciate at 8, 10, 15% annually, while your cost of capital is 2%. The difference compounds year after year after year. This is capital leverage at its purest form. Buffett isn't working harder as he gets older. He's not grinding longer hours. His leverage ratio is approximately 1.9 to 1, meaning he controls $1.90 in assets for every dollar of equity. The system multiplies his results automatically. Now compare that to how most people use debt. They borrow money to buy cars that depreciate 20% the moment they drive off the lot. They finance furniture, vacations, consumer goods, liabilities that lose value and generate zero return. The wealthy do the exact opposite. They borrow to buy assets that appreciate or generate income. Real estate that produces rental cash flow, businesses that compound earnings, investment portfolios that grow. If you want to know how wealthy someone is, look at how much debt they can responsibly leverage against appreciating assets. The more productive debt they control, the wealthier they are. This inverts everything you were taught about debt being bad. Debt for consumption is bad. Debt for assets is the foundation of generational wealth. Elon Musk understands this principle at a molecular level. As of 2024, Musk had pledged approximately 236 million Tesla shares, worth roughly $82 billion, as collateral to secure personal loans. Why would someone worth over $200 billion need to borrow money? Because liquidating Tesla shares triggers massive capital gains taxes. 30 to 40% of every dollar sold vanishes to taxes immediately. Instead, Musk borrows against his shares. He accesses billions in liquidity without triggering a single tax event, preserving his equity while deploying capital for acquisitions like his $44 billion purchase of Twitter. This is the invisible lever at work. Musk doesn't touch his own money when he can borrow at favorable rates against appreciating assets. His net worth grows tax-deferred while he uses borrowed capital to build additional wealth-generating enterprises. It's capital leverage layered on capital leverage, compounding in ways that linear income earners can't even comprehend. And here's the critical insight. This strategy only works when the underlying assets appreciate faster than the borrowing costs. Musk's Tesla shares have appreciated at rates that dwarf his interest expenses, making the leverage profitable by default. If you're starting to see the pattern, you're ahead of 99% of people. The wealthy don't grind for money. They structure leverage systems that generate returns while they sleep. And if you're realizing you've been operating under the wrong equation your entire life, do yourself a favor, subscribe to this channel. What I'm sharing here isn't theory. These are the exact playbooks the ultra-wealthy use, and I'm breaking them down step by step. Don't miss the next one. Capital leverage is powerful. But in the modern economy, there's an even more explosive multiplier. Code. Code is perhaps the most potent form of leverage ever created because it decouples effort from output entirely. You write a solution once, and it serves infinite users with nearly zero marginal cost. This is why software companies generate more wealth today than traditional manufacturing ever could. When you build a car, every additional car requires raw materials, labor, assembly, linear scaling. When you write software, every additional user costs almost nothing to serve. Exponential scaling. Let me give you a concrete example. Slack, the workplace messaging platform, wrote its core code once. A relatively small team of engineers built the product over a few years. Once deployed, every new user that signed up cost Slack virtually nothing to serve. The first user and the 10 millionth user consumed roughly the same server resources per capita, but each additional user generated subscription revenue. As the user base grew, Slack's profit margins expanded dramatically because infrastructure costs remained relatively flat while revenue multiplied. This is code leverage in its purest form. One unit of engineering effort, creating permanent, recurring value that scales infinitely. Compare that to a consulting business. If you're a consultant, you trade time for money. You can serve maybe 10 clients if you're working 60-hour weeks. To double your revenue, you need to double your clients, which means doubling your hours. There's no leverage. You hit a ceiling determined by your personal time availability. But if you take that same consulting expertise and encode it into software, a diagnostic tool, an automated system, a platform, suddenly you can serve 10,000 clients with the same amount of effort it took to serve 10. The software does the work. You capture the value. This is why tech billionaires multiply wealth faster than any other category of entrepreneur. They've mastered code leverage. Mark Zuckerberg understood this from day one, but he took it further. He didn't just build software that scaled. He built software that controlled access to something more valuable than the platform itself: data. Leaked internal documents revealed that Facebook strategically weaponized its Graph API, the system allowing third-party applications to access Facebook's user network. Zuckerberg granted favorable data access to companies that paid through advertising or data-sharing arrangements, while denying it to competitors. One internal email captured the strategy perfectly. The purpose of the platform is to tie the universe of all the social apps together, so we can enable a lot more sharing and still remain the central social hub. This wasn't just code leverage. This was using code as financial engineering. Zuckerberg controlled the gates to billions of users. If you wanted access, you played by his rules. Pay for ads, share your data. Promote Facebook's interests, refuse, and you got cut off. The leverage wasn't just in the platform's ability to scale, it was in the platform's ability to dictate terms to every other business trying to reach Facebook's audience. That's code leverage compounded by network effects and data monopolization. And it made Zuckerberg one of the wealthiest people alive before he turned 40. But perhaps no one deployed code leverage with more patience and precision than Jeff Bezos. In 2006, Amazon launched Amazon Web Services, a cloud computing platform that let other companies rent server space and computing power. For 7 years, AWS ran at a loss. Bezos hemorrhaged money building infrastructure, hiring engineers, refining the product. Most companies would have killed the project. Bezos kept funding it with profits from his e-commerce operations. He understood something most CEOs don't. Leverage takes time to compound, and if you have the capital to be patient, the long game wins. By 2024, AWS generated $108 billion in annual revenue with 19% year-over-year growth. It delivered over 50% of Amazon's total profit, despite being just one business unit. That patience, funded by a profitable core business, created one of the most valuable companies on earth. Competitors couldn't replicate it because they lacked the patient capital, the existing customer base, and the willingness to absorb years of losses for future leverage. Bezos built a system that now scales infinitely, printing billions in profit annually, with minimal additional effort required. That's code leverage at the highest level. Now here's the question you need to ask yourself. What can you build once that serves many? What expertise, system, or solution can you encode so it works without your direct involvement? Because if you're still trading hours for dollars with no scalable system behind you, you're leaving exponential returns on the table. Write that down, think about it. And if this is making you rethink your entire approach to work, drop a comment below with your biggest takeaway so far. I want to hear what's clicking for you. Code leverage is powerful. But there's a lever most people completely overlook because it seems too simple. People. The wealthy don't try to know everything or do everything. They know the right people, and they delegate strategically to scale beyond their personal limitations. This is people leverage, and it's how you break past the ceiling of your own 24 hours. Peter Thiel is a master of people leverage. His Thiel Fellowship, launched in 2010, provides funding and mentorship to young entrepreneurs, specifically encouraging them to skip college and pursue startups. By 2014, the fellowship had backed 20-year-old Vitalik Buterin, who co-founded Ethereum, now one of the most significant blockchain networks in history. Thiel didn't build Ethereum. He identified talent, provided capital and mentorship, then participated in its exponential growth without doing the operational work. That's people leverage. But Thiel's real genius wasn't just mentoring individuals. It was building a network that created compounding returns. Through his Founders Fund, Thiel made early investments in Facebook, SpaceX, Stripe, Airbnb, LinkedIn, and DeepMind. These companies collectively created hundreds of billions in value. Thiel didn't build them. He selected them, advised them, and connected them with other talented people in his network. Each successful investment strengthened his reputation, which attracted better deal flow, which led to more successful investments. The network became self-reinforcing. This is people leverage at scale, using relationships, reputation, and strategic positioning to multiply impact without proportional time investment. Ray Dalio took people leverage in a completely different direction. He built Bridgewater Associates into the world's largest hedge fund, managing $160 billion, not by making every decision himself, but by systematizing decision-making and embedding it into organizational processes. Dalio documented his management principles and created what he calls the Principles Operating System, an algorithmic framework that allows thousands of employees to make decisions aligned with his philosophy, without requiring his personal involvement. Think about what that means. Dalio encoded his thinking into a system. Now his ideas scale across an entire organization automatically. Employees make decisions as if Dalio himself were guiding them, but he's not in the room. He's not on the call. He's not reviewing every report. The system does it. This is people leverage through systematization, transforming personal expertise into organizational infrastructure, so your thinking multiplies without your direct presence. Most entrepreneurs remain the bottleneck in their businesses because they haven't systematized their decision-making. Dalio eliminated himself as the bottleneck and turned his organization into a machine that operates according to his principles whether he's there or not. Bill Gates deployed people leverage differently through the Gates Foundation. Rather than attempting direct implementation of global health initiatives, the foundation partners with governments, NGOs, multilateral organizations, and the private sector to achieve transformational scaling. A perfect example, the foundation invested $20 million in MoSIP, a digital identity platform for India. That $20 million mobilized an additional $2.5 billion in World Bank funding, reaching millions of Indians with digital IDs. The leverage ratio was over 100 to 1. Gates didn't build the infrastructure. He provided catalytic capital and credibility that unlocked vastly larger resources controlled by others. That's people leverage through strategic partnerships, using your network and reputation to move resources far beyond what you personally control. LeBron James transformed himself from a basketball player into a business enterprise by treating partnerships as leverage vehicles. Rather than simply endorsing products for flat fees, he invests in companies and positions himself as an active stakeholder. When he left a $15 million annual McDonald's endorsement deal to partner with Blaze Pizza, a company he had invested in earlier, he took a short-term income hit for long-term leverage. His social media following, over 93 million combined across platforms, provided distribution and credibility. His ownership stake provided profit participation and executive influence. The combination multiplied his wealth far beyond traditional endorsements. He wasn't just being paid for his name. He was using his name as leverage to build equity in appreciating assets. This is the pattern. The wealthy build networks, systematize decision-making, catalyze partnerships, and delegate strategically. They don't hoard responsibility. They distribute it to capable people whose success becomes their success. If you're doing everything yourself because you think no one else can do it as well as you, you've already lost. You've capped your potential at your personal capacity. The moment you recognize that 10 people executing at 80% of your capability produces far more than you executing at 100%, you unlock people leverage, and your wealth trajectory changes permanently. Now let's talk about the final lever, the one that most people think doesn't apply to them: media. Media leverage is the ability to control narratives, build personal brands, and shape how people perceive value. And here's what most people miss: media leverage compounds because each use of the platform simultaneously promotes future uses. Every piece of content you create makes the next piece more valuable. Because your audience grows, your credibility strengthens, your distribution expands. Oprah Winfrey built a $2.8 billion fortune not primarily through talent, but through media leverage. Her career trajectory demonstrates the compounding nature perfectly. She started as a news anchor, became a talk show host, then became a producer who controlled production. The turning point was when she maintained ownership of the Oprah Winfrey Show. That decision transformed her from a performer dependent on network paychecks into a media proprietor who captured the economic value of her brand. By 1995, she was worth $340 million. By 2000, $800 million. By 2003, she crossed the billionaire threshold. What made this possible wasn't her talent for interviewing. It was her recognition that owning the distribution channel was far more valuable than being distributed through someone else's channel. Every appearance on her show promoted her magazine, book club, and foundation. Every book she mentioned became a bestseller not just because the publicity was valuable, but because her endorsement wielded such gravitational force on the market. She became the platform, and platforms capture exponentially more value than participants on the platform. Tony Robbins achieved similar leverage through media, but deployed it differently. Rather than trading time for consulting fees, he built a brand around personal transformation that monetizes through books, seminars, podcasts, and video products, all leveraging his media presence to sell solutions to millions simultaneously. His message can be consumed by 100 people or 1 million people at the same marginal cost once recorded. The leverage multiplies his impact without multiplying his effort. Every piece of content works for him in perpetuity, generating revenue, building credibility, attracting opportunities. Elon Musk, with over 193 million followers on X, demonstrates media leverage on a scale most people cannot fathom. His posts move markets, influence culture, and shape regulatory conversations. When Musk tweets about Bitcoin, the price moves. When he criticizes a competitor, their stock drops. When he announces a new product, millions pay attention instantly. This isn't because he's the loudest, it's because his media presence, amplified by both owned platform control and earned media attention, makes him culturally gravitational. Every statement generates discussion, attracts capital, and influences talent allocation globally. He doesn't need to convince people one-on-one. He broadcasts to hundreds of millions simultaneously. That's media leverage. And here's the critical insight for you. Media leverage isn't just for celebrities. If you have expertise, if you have insights, if you have a unique perspective, you can build media leverage, start a podcast, build a YouTube channel, write articles, create content that serves your audience. Every piece of content is a leverage multiplier because it works for you after you've created it. Someone can discover your content 5 years from now, and it still delivers value, still builds credibility, still generates opportunities. That's compound interest on attention. If you're not building some form of media leverage right now, you're voluntarily leaving one of the most powerful wealth multipliers unused. Think about that. Now that you understand the 4 levers, let's talk about how to actually deploy them. Because understanding leverage intellectually is one thing. Implementing it is entirely different. And this is where most people fail. The wealthy don't treat all activities equally. They systematically identify which 20% of their activities generate 80% of their results. This is the Pareto principle, and it's the foundation of leverage thinking. Here's the framework. Step 1. Identify your unique contribution. The highest leverage work involves activities only you can do, or that you can do significantly better than others. Ask yourself, what would happen if this task were delayed or delegated? Could someone else handle this equally well? Does this require my specific knowledge, relationships, or decision-making authority? Warren Buffett spends his time on capital allocation decisions that generate billions in returns, not on administrative tasks anyone could handle. Mark Zuckerberg focuses on platform strategy and data monetization, not on code writing that thousands of engineers could do. Your highest leverage work is where your unique capability intersects with maximum impact. Step 2. Ruthlessly eliminate non-leveraged activities. The wealthy recognize opportunity cost acutely. For every activity you choose, you're choosing not to do something else. If a task doesn't multiply or scale, it becomes a liability consuming time that could be allocated to leverage activities. This is why Ray Dalio automated decision-making that didn't require his personal judgment, and why Jeff Bezos stopped attending operational meetings that didn't involve strategic decisions. Here's how to categorize your activities. Activities that scale infinitely, code, media, capital deployed, should consume the majority of your time and resources because one unit of effort creates permanent recurring value. Activities that require personal involvement but have declining returns, mentoring specific people, making key decisions, should be strategized carefully to maximize multiplier effects. Activities that don't leverage or scale, routine administration, low-value meetings, repetitive tasks, should be automated, delegated, or eliminated. Most people spend 80% of their time in that third category and wonder why they're exhausted but not wealthy. You need to invert that ratio. Step 3. Reinforce and systematize your highest impact lever. Once you identify your primary leverage source, the strategy becomes systematic reinforcement. If people leverage is your strength, build systems and networks that make your people leverage increasingly powerful. If code leverage dominates, invest relentlessly in platform development and distribution. If media leverage is your edge, create content systems that make your influence scale. Buffett's entire Berkshire Hathaway structure reinforces capital leverage through insurance float, which enables capital deployment, which generates returns, which fuel more capital accumulation. Each component strengthens the others in a compounding flywheel. That's not accidental. That's designed, and you can design the same structure in your life and business. But here's where most people sabotage themselves. They make fatal mistakes that prevent leverage from ever working. Let me show you the 4 biggest ones. Mistake 1: treating all time as equal. Average people believe that more hours equal more results. They grind harder, work longer, assuming effort correlates linearly with outcomes. This is precisely backward. Buffett recognizes that 1 hour spent identifying an undervalued company worth billions is worth more than 1,000 hours spent on operational minutiae. The leverage multiplier matters far more than the time invested. If you're measuring productivity by hours worked instead of results generated through leverage, you're playing the wrong game. Mistake 2: underestimating leverage timelines. Leverage isn't instant. Bezos ran AWS at a loss for 7 years because he understood that building a leverage system requires patience. Most people abandon leverage strategies after months of unremarkable returns, reverting to linear activity where results appear quickly. This is why so few people build enduring wealth. They lack the willingness to sacrifice short-term results for long-term leverage. If you're not willing to invest in systems that take years to compound, you'll never experience exponential returns. Mistake 3: confusing activity with leverage. The busiest people are often the least leveraged. They're executing but not scaling. They're solving problems for individual clients, instead of building systems that solve problems for thousands. They're responding to others' priorities, instead of building platforms that attract others to their priorities. Being busy doesn't mean you're building leverage. Often it means the opposite. You're trapped in reactive mode, serving others' leverage systems instead of building your own. Mistake 4: borrowing for consumption rather than assets. Capital leverage only works when debt funds assets that generate returns exceeding the borrowing cost. The poor and middle class borrow to buy liabilities, cars that depreciate, goods that consume, experiences that vanish. The wealthy borrow to buy assets, companies that appreciate, real estate that generates income, infrastructure that produces value. This distinction alone explains wealth inequality across generations. If you're using debt for anything that doesn't generate future cash flow or appreciate in value, you're doing it wrong. And here's the truth that ties everything together. Leverage multiplies leverage. The most powerful insight about leverage is that it compounds. As you deploy one lever successfully, it enables deployment of others. Buffett's capital leverage creates the resources for people leverage, hiring exceptional talent, acquiring businesses with quality management. His people leverage multiplies capital returns. Higher capital returns fund more capital deployment. The cycle accelerates. Oprah's media leverage created capital, billions earned. That capital became investment capital that diversified her wealth. Her media leverage attracted talented people who built complementary businesses. Each lever reinforced the others in a geometric progression. This is why wealth isn't linear. This is why some people reach billionaire status, while others work their entire lives without accumulating substantial wealth. The wealthy recognize that the game isn't about working harder. It's about pulling the right invisible levers, then systematically reinforcing them until they multiply on themselves. The invisible lever doesn't make effort irrelevant. It redirects effort toward activities and systems that multiply impact rather than activities that consume time. It transforms the fundamental equation of wealth from time multiplied by hourly rate equals income into leverage, multiplied by deployed resources equals exponential returns. Let me give you a final case study that illustrates everything we've covered. There's a reason why certain people seem to accumulate wealth effortlessly, while others grind without results. It's not luck. It's not connections. It's not even intelligence. It's leverage architecture. Consider two entrepreneurs starting businesses at the same time. Entrepreneur A starts a consulting firm. Brilliant insights, exceptional execution, premium pricing. She works 70-hour weeks, serves 20 clients per year, generates $500,000 in annual revenue. 10 years later, she's still working 70-hour weeks, serving 25 clients, generating $600,000 in revenue. Incremental growth, linear scaling, no leverage. Entrepreneur B starts with the same expertise but builds differently. Year 1, she creates an online course encoding her consulting methodology. It takes 6 months to build. Revenue is minimal. Year 2, she hires a marketing specialist and a customer success manager to scale distribution. Still barely profitable. Year 3, the course reaches 1,000 customers. Year 4, 5,000. Year 5, 20,000 customers at $500 each. $10 million in annual revenue with a team of 15 people. She's working 30 hours per week. That's code leverage, people leverage, and media leverage compounding. Same expertise, same starting point, radically different outcomes. The difference was leverage architecture. Entrepreneur A traded time for money. Entrepreneur B built systems that multiplied effort. Now here's the question that should be burning in your mind. Which entrepreneur are you? Are you grinding harder every year for incrementally better results? Or are you building leverage systems that compound? Because if you're honest with yourself, most of you are entrepreneur A. You're working harder, not smarter. You're executing, not systematizing. You're busy, not leveraged. And that's exactly what this channel is designed to fix. If you're still watching, you're different from most people. You're willing to confront uncomfortable truths about how wealth actually works. You're not looking for get-rich-quick schemes. You're looking for the real playbook. And I'm going to give it to you piece by piece, strategy by strategy. But I need you to take action right now. If you haven't subscribed yet, do it now. We're building something different here. A community that understands leverage, applies it and wins because of it. I want to hit 100 subscribers, and I need your help. Hit that subscribe button. Leave a like if this changed how you think about wealth, and drop a comment below answering this question. What's the one lever you're going to start building this week? Capital, code, people, or media? Tell me where you're going to focus and why. I read every comment. I want to know what you're working on. Here's the truth. Everything I shared today won't matter unless you implement it. Knowledge without execution is just entertainment. The wealthy don't consume information for fun. They consume information, extract the leverage insights, and deploy them immediately. So take what you learned today and ask yourself, what's the single highest leverage activity I should be doing right now that I'm not doing? What am I spending time on that doesn't scale? What system can I build once that serves many? The invisible lever separates the wealthy from everyone else. Not harder work, not more hours, better leverage. Capital that multiplies, code that scales. People who extend your capacity. Media that compounds attention. These are the levers. Now you know they exist. Now you know how they work. The only question left is whether you'll pull them. This is William Vanderbilt. Build leverage, build wealth, and I'll see you in the next one.